When someone in Canada passes away, there's a tax bill waiting. Even though this country doesn't have an inheritance tax, doesn't have an estate tax, doesn't have a death tax of any kind. On an ordinary family's savings, that bill can still run close to $100,000. Here's exactly how that happens.
Two terms people mix up constantly. Inheritance tax, charged to the person receiving money. Estate tax, charged on everything someone owned before it's even handed out. Canada has neither, officially, today, because it did have both once. So that headline? Completely true. Family leaves you money, you personally own nothing on it. But that only covers the receiving end. What happens to everything someone owned in the moments right before it's handed out? Whole different story.
Here's the actual rule doing all the damage. It's called deemed disposition. The moment someone dies, the government treats it as if they sold everything they owned that exact day. Nothing was actually sold. Doesn't matter. This happens whether there's a will or not.
So who pays a tax bill for someone who's gone? The estate does. Before a single dollar reaches the family, the executor files one final return covering January 1st through the date of death. Whatever's owed comes out of the estate's own money first. To be fair, this only bites when something gained value. Lost value instead? No tax at all. Counts as a loss. Can even cancel out tax owed somewhere else on that same return.
Here's where it actually hurts. A cottage bought years ago for $200,000, worth $700,000 now, $500,000 gain. The day the owner dies, that gain gets treated as cashed in, even though the cottage never sold to anyone. Half that gain lands on the final tax return, taxed at the person's regular rate. On a gain this size, well over $100,000 owed, straight out of the estate.
And it's not just cottages. Same rule hits non-registered investments. That's just any investment account outside a TFSA, RRSP, or similar registered plan. Regular stocks, ETFs, whatever's sitting in a normal brokerage account. Also business shares, valuable belongings, any extra property. Basically, anything that could have grown in value while it sat there.
One real exception exists. A family gets to fully protect exactly one property from this. Almost always the home they actually lived in. But here's the catch. One property, full stop. 2 houses, 3 cottages, doesn't matter. One gets protected. Everything else, exposed. Retirement accounts get hit even harder than the cottage did. An RRSP, a RRIF, or an FHSA, none of them get the 50% break. The entire balance counts as full income in one single year.
A $400,000 RRSP added all at once pushes income way up for that year. The lower portion still gets taxed at lower rates, same as normal, but a big piece of it lands in the highest tax bracket in the country, taxed at over 50% just on that top slice. Still a brutal hit on money saved over an entire lifetime.
One major way around both of these, leaving everything directly to a spouse. Doesn't need to be a citizen, doesn't need permanent residency either. What actually matters is tax residency, meaning they genuinely live here with real ties to Canada. An ex-spouse doesn't qualify, and if that spouse already passed away first, this exception simply isn't available. The estate gets taxed the regular way instead.
None of this needs a loophole, just legal, ordinary planning. Life insurance bought specifically to cover a future tax bill, gifting some non-registered assets earlier in life, a spousal trust. One thing that does not work, gifting an RRSP directly. Can't be done. Money has to come out first, and the moment it does, it's taxed as income right then. No shortcut around that one. One more cost, separate from everything so far. Before an estate can be legally settled, most provinces charge a probate fee, the cost of a court confirming the will is real and the executor actually has authority to act. Entirely dependent on where someone lives. Manitoba? Nothing. Alberta? Capped around $500. Ontario, this exact estate owes over $10,000 in probate fees alone. Quebec has its own move here, a notarial will, prepared and kept by a notary while someone's still alive. Because the notary's already verified it, the court doesn't need to check it again later, skips probate almost entirely. So, for this one family, one cottage, one RRSP, one home protected, living in Ontario, total lands somewhere between $95,000 and $105,000. That number isn't universal. More properties, a bigger RRSP, a different province, and it moves completely. But for an ordinary family like this, that's real money, and not one line of it was ever labeled estate tax on any form. It just adds up to exactly the same thing.
To be fair, none of this is a trick. It's just how Canada taxes gains and retirement income, applied at the one moment the person who built all of it isn't around anymore to manage any of it. A few things genuinely soften this. One property protected, a spouse to leave things to, the right tools used ahead of time, not after, none of it complicated, just needs knowing about before it's too late to matter.
Canada really doesn't have an estate tax. Completely true sentence, just barely the important part of the story. More than one property? A cottage? A big RRSP? This is the conversation worth having now, not later. If this made it clearer, hit subscribe. Canadian Life Simply Explained. See you in the next video.